The Congressional Budget Office has just released new 10-year projections for the US budget and economic outlook, an update from its previous forecast made in February, revealing a very concerning direction that they believe things are heading in, as they are now projecting things to become even worse. Under the CBO's latest baseline projection, federal debt held by the public will grow from $27 trillion today to $51 trillion by the end of 2034, an increase of $23 trillion in just 10 years. Now, as a percentage of GDP, this equates to debt rising from the current level of 97.3% to 106.2% of GDP by 2027, exceeding the previous record set just after World War II, before growing again to a whopping 122.4% of GDP by 2034. And this 122.4% figure in 2034 has been increased since just 4 months ago in the CBO's February projection, in which it was 116% of GDP. Now, this is a clear sign that the CBO believes that things have only gotten worse since the start of the year, as the US government has continued to recklessly add to their total national debt, and these new high projections confirm that national debt is still on a completely unsustainable path. Meanwhile, the budget deficit is projected to rise to $1.9 trillion, which is 6.7% of GDP in 2024, up from $1.7 trillion in 2023, before rising over the next 10 years to reach $2.9 trillion in 2034, or 6.9% of GDP. Now, this is a staggering $22.1 trillion in unaccounted for deficit spending in just over 10 years between 2025 and 2034. And the CBO predicts that net interest payments are going to be driving the growth in this budget deficit, with interest payments expected to cost a near record-breaking 3.1% of GDP this year in 2024, exceeding defense and Medicare spending. Now, interest payments are then expected to set a new record next year and over time grow to 4.1% of GDP by 2034. And what is fascinating about this interest payment growth trajectory that is being forecast by the CBO is that it means that interest spending will overtake primary deficits in the coming years, and the gap will only continue to grow over time. In recent history, the government has previously been able to get away with issuing debt to cover budget deficits, thanks to interest rates being close to zero. However, this is now much more punishing, with interest rates now being considerably higher, and with many economists and institutions not only predicting interest rates to remain higher for longer, but also to not ever return to the lows that we have seen during the majority of the 2010s, debt is likely to continue to cost more than what we have seen in recent history. Nation-states are also signalling their lack of faith in the US economy too, with central banks from advanced economies expecting to reduce their reserve allocation in the US dollar in exchange for gold. 60% of rich countries' central banks believe that gold's share of global reserves will rise in the next 5 years, up from 38% last year. And around 13% of advanced economies plan to increase their gold holdings in the next year, which is the highest level since the survey began and is up from 8% last year. This does follow the lead of emerging market central banks, which have been the main purchasers of gold since the 2008 global financial crisis. Meanwhile, 56% of advanced economies also think that the dollar's share of global reserves will fall over the next 5 years, which is up from 46% last year, and this figure is as high as 64% amongst emerging market central banks. The dollar's share of global foreign exchange reserves, excluding gold, has dropped from over 70% in 2000 to around 55% last year, according to the IMF. And when including gold, the US dollar's share has fallen below 50%, the World Gold Council says. In recent years, we have also been witnessing a divergence emerge between gold prices and US Treasury prices, breaking the historic correlation between these two asset prices. This is yet another signal that investors are becoming more fearful about owning US debt and the growing risks that come with owning it, and are instead opting to park their money in gold. Now, some of this is due to a lack of demand from investors, as we have seen various US debt auctions in recent months suffer from weak demand. but it is also being driven by some of the biggest global central banks halting purchases of US Treasuries and even beginning to sell off their holdings too. This includes China, who have been selling off their US Treasuries since 2015, however the pace of which has accelerated significantly over the past couple of years. And when we look at the share of US Treasuries owned by foreign central banks over time, we can see that the share has gone from 40% in 2008 to now being around 14%, with this decline also getting steeper in recent years. This paints a very clear picture that the foreign appetite simply is not there to keep up with the pace at which the US is issuing new debt. On top of this, just the other week we saw Saudi Arabia abandon the US dollar in its oil trading with their long-standing petrodollar agreement that was established back in 1974 coming to an end without a renewal. This will enable Saudi Arabia to sell oil and other goods in various alternative currencies, which includes the Chinese RMB and various other currencies, instead of trades being done exclusively in US dollars. This move from Saudi Arabia does signal their willingness to move away from the dependence on the US dollar, with the Atlantic Council saying that this will put a dent in dollar dominance and offer a symbolic win for de-dollarization. Hung Tran, senior fellow at the Atlantic Council, did say China has become Saudi Arabia's largest oil customer, accounting for more than 20% of the kingdom's oil exports. Beijing has established close trade-driven relationships throughout the Middle East, where US influence has waned. Now, Saudi Arabia is part of the BRICS bloc of emerging nations that have been quite vocal about de-dollarizing and are reportedly planning to build and establish a new payment system called mBridge. This is a multi-central bank digital currency to enable instant cross-border payment settlements and foreign exchange transactions. Now, Tran also made a comment on this, saying, if such payment ecosystems make ground, it is a real threat to US Treasury liquidity, risking a key pillar of the greenbacks, i.e. US dollars, international position. Now, with the US debt issue becoming a bigger and bigger problem and projections on the future getting worse and worse, we are also starting to see warnings come from a number of prominent figures, including large Wall Street institutions, with some of their predictions being very concerning. Now, speaking on a panel earlier this year, JP Morgan CEO Jamie Dimon believes that the US faces a global market rebellion over record US debt. Dimon highlights that in the past, during a recession, the government would spend money and the deficit was 4 or 5%, but today, during a boom time, it is 6.5%, which is a very interesting point to make because it does beg the question of how large the deficit will get to during the next recession. Dimon believes that the federal debt held by the public to GDP ratio will rise to 130% by 2035, similar to the CBO projection, referring to the shape of the debt to GDP ratio as a hockey stick. He adds, that hockey stick doesn't start yet, but when it starts, markets around the world, there will be a rebellion. Now, former Speaker of the House, Paul Ryan, was on the same panel, and he did say that the debt spiral is the most predictable crisis we've ever had, with Jamie Dimon agreeing with this. And Jerome Powell himself has even passed comment on the national debt situation, saying it is past time for an adult conversation about unsustainable fiscal policy. Professor João Gomes, Vice Dean of Research at the University of Pennsylvania's Wharton School, has long warned of the severe and probably irreversible scars on our economy and society if federal spending does continue unchecked. He recently told Fortune it could derail the next administration. If they come up with plans for large tax cuts or another big fiscal stimulus, the market could rebel. Interest rates could spike right there and we would have a crisis in 2025. I'm very confident by the end of the decade, one way or another, we will be there. Now, with all of this in mind, Jerome Powell and the Federal Reserve have a number of critical decisions to make in the coming months on what happens with interest rates. But it is looking increasingly likely that they have no idea what to do, as cutting rates will risk inflation spiking again, causing a period of stagflation. But keeping rates higher for much longer could cause carnage across many sectors of the economy, including the banking sector, which currently has a number of banks very close to collapsing. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you did enjoy the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.